We had a big bullish move last week, inducing buyers, and then a big sell-off following it, trapping the buyers when we run these lows, and then came down to these lows to the left-hand side, and we are now starting to engineer more liquidity at the lows. Perfect. So from there, we've respected the lows and gone bullish, okay? Taking out some internal liquidity here, right? Mitigating this imbalance, and also coming into this 4-hour liquidity block right here. Okay, so let's go down to the 1 hour. Perfect. So why is this internal liquidity point valid? Well, you can see from this high, we sold off, taking out previous low. Okay, I'll even go to the 15 so you can see it a little bit better. So again, from this high, we sold off, taking out the previous low, and then we came back and respected these areas on the left-hand side. So now we're starting to engineer liquidity. Okay, you can see kind of structurally speaking. Okay, and now we're respecting that bottom from the left-hand side like we spoke about, those lows to the left. It's a higher time frame area, so what you can expect is lower time frame to go bullish for a little bit, okay? Because this is all going to end up being liquidity, right? So to begin with, this was Friday. You can see how price came back up, respected these highs here, okay? Engineering even more liquidity here. Perfect. Look how price ended up sweeping a low, grabbing that liquidity, and then going long right into those highs that we are engineering liquidity at, okay? So from there, that wrapped up the price action basically on Monday because then New York ended up being quite stagnant. But going into today, so late New York, actually, what happened was we ended up taking this internal liquidity point to the left-hand side over here. But look what price did. Okay, so we came up, took that liquidity, came back down, and essentially just respected order flow, respected these lows. So now what does that tell me? Keep an eye on this low, okay, because this is where liquidity is going to be now. As we know, the market just doesn't work like this, operate where it just keeps on respecting lows. Okay, what it's doing now is engineering liquidity to the downside. Lots of buyers are entering the market now. Look here, take out the high, price returns to the low, respects this, and runs away. What does that tell me? Liquidity below this low as well. Perfect. So approaching New York session, excuse me, we tapped into this H4 liquidity block to the left-hand side. Apologies, I just noticed I don't have the price points on the right-hand side in the recording, but it's not too important. But yeah, it's probably gonna look a little ugly on your guys' side, but apologies about that. Okay, so again, we mitigate that H4 area from the left. Now we're approaching New York, so let's mark on New York open here so we get an idea of what time it is. I know not everybody's on the same time zone as me. Cool, so we're in New York now. Okay, so now what's going on? Well, like we spoke about, look at all the liquidity now we're starting to leave to the downside. Again, took out that previous high, price comes back down and respects lows. So I'm interested in this low now as well. 2 targets, okay? The difference between them, 7 pips, so still not bad. It's EU, so 7 pips is decent. So again, New York open, we just opened up here. Price, look how it spikes up, grabs, let me get rid of the vertical line so you can see a little bit better, but grabs this internal point, okay? And then sells off. What does that now leave us? This area is a liquidity block, okay? From there, we sell off. Look how we get a pullback, mitigation somewhere in here, okay? And then what happens is we sell off again and take out the low. So now we have a trap occurring. And I did fast forward a little bit too far, but this was now an area that you do not want to be selling from, okay? Because this is going to be what retail is going to be looking to sell from, all right? And we're not interested in that. What do we have right above? A liquidity block. So if this is a level of liquidity for us, and this is a point where price can reverse, why not take a trade as soon as price runs this high? Okay, you have a 1-minute imbalance here that we haven't filled yet. You also have a 1-minute imbalance at the extreme, which price can run to, no problem. But is it gonna? Do we always expect it's gonna fill in every single 1-minute imbalance? No. That's why it makes sense to just take the entry above the high. Stop loss goes above the liquidity block, and then we target these liquidity points at the opposing side of the market, okay? So this would have been entry number one. Let's see how it plays out. Okay, we get tagged in, it goes a little higher. Look how it actually ends up mitigating the extreme, okay? So sometimes at this point, look how we've now taken out some internal point here. What you can expect sometimes when we do this is price to run up, run the high again, and then drop, and that's exactly what happens. Look, spike the high, and boom, we fall from there, okay? So that would have been entry number one. Let's move this over. How could we involve ourselves if we didn't take this entry here? Well, let's move this over. Okay, so now hop back on the M5. As I've spoken about a lot in the past, M5 is usually the time frame I'm on when I'm taking entries. Only time I'll hop on M1 is when M5 needs to be refined. And what do I mean by that? Is you see how these bunch of candles here on M5 from 820 to 855, it's kind of squeezed. I can understand what's happening. I guess just because of my experience. But sometimes when it's squeezed like this, it's easier to just bump down the time frame and you can see what's going on a little bit more. Okay. And that's when how I recommend to go down to M1 is when M5 needs to be refined. Okay. When price action is a little too squeezed up and you need to understand what's going on more. Cool. So from there, we move to the downside. Okay. And we trade below the low again. Now what happens? We're still trading with this point here, this trap you could call. Why is it a trap? Well, if our bias is to the downside, we understand that the market does not just take previous highs, okay, and get a retracement, respect these bullish areas and continue bullish. We've just taken out all of this liquidity, okay? And again, we have liquidity on the opposing side of the market. So we're not going to keep buying with the liquidity. We're going to trade into it, right? So this is going to be a trap. So every time the market stabs into here and gives us a reaction the other way, it's a sell opportunity. Okay, so essentially every single time we come down, we get a reaction and move higher, it's a sell. We move lower, get a reaction, sell, and so on. Okay, so that's what I want you to get in your head here. Every single time we get a bullish reaction, it's just going to be a trap. Perfect. So what did I wait for? Simple stuff. We traded above this inducement high. And again, price action is kind of squeezed on M1. So we can look on M5, or sorry, price action was squeezed on M5. So we go to M1, no problem. Look how price came up here, printed this high, and then we came below previous low, took it, and then we returned back to the extreme and did what? Built liquidity. And then sold off again, taking out previous lows, and then price comes all the way back and still builds liquidity. What does that tell me? We want this taken now. Okay, look at the buildup of liquidity we just got in this area. So price does exactly that. We come up here, engineer liquidity, we get a pullback, mitigation at the extreme, okay? And then we go long to take out that liquidity that we engineered above here, okay? Perfect. So the reason why I'm not just gonna be taking an entry above here is because look how big my stop loss is gonna have to be. It's gonna be over 5 pips. That's not too much, but the thing is, I'm only targeting here. So you're still catching a 1 to 3. It's just something I'm not too interested in personally. I will be waiting for a more refined entry, or if we come really deep into this area, we could possibly take one here. Okay, so let's see what price action gives us. Perfect. Next M5 candle. Look what we do. We close below the previous candle's low, and what does that create for us? A liquidity block. So we need to wait for price to come back and retest previous candle low. Look what next candle does. Boom. Tags us in. Stop goes above a high. And we are targeting the next liquidity point to the downside. So how did I go about managing this trade? When we took this low, partials are taken. Okay. Why? Well, because liquidity is taken and we can see a pullback. Normal stuff. So look how we respect the low for a little bit again, just to induce buyers, no problem. And then boom, trade below it. So again, that's a partial point. Now we can hold the rest to here, close more partials. Boom, another partial point hit. So what I did was as soon as we took this low, I'm 90% out now. Why? Well, because there's still a possibility that we can continue to the downside. Look at the engineered liquidity. We have the lows. Again, we engineered even more liquidity because of these lows over here. So look how the market came down, respected the past. So now we got even more of a reason to push lower to here. So that's kind of my swing kind of target, my intra-week target. But as for my intraday, I'm paying myself when we sweep these lows here, okay? Because is it impossible for us to sweep this and continue long? No, it's not. You want to be aware of these things and not get too greedy and pay yourself at these lows, right? Right here, right here. And then, yeah, now we're trading within this imbalance and stuff. So, yeah, that concludes this case study on the euro dollar. Hope you guys enjoyed, and I will see you guys in the next one.